Hello, everyone. Today on the final bar, I'll be catching up with Mish Schneider of MarketGauge. We'll see some of the charts that she is looking at. The market's sort of in this weird, unstable, sort of unknown territory. Which way do we resolve? Higher or lower? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and beautiful Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the language of technical analysis. I was doing an interview earlier today and was asked about the premise of technical analysis. Why would you suggest that technical analysis works? And my answer was because I feel that prices represent where investors are at. It is one of the most effective measures of investor psychology, I think, anywhere, because excitement, desperation, euphoria, panic, all are reflected, arguably, in the prices of exchange-traded assets. And as John Murphy told me in the first book that I ever read on technical analysis, price reflects all known information, or certainly the way people are acting or interpreting that known information. I think that's a key premise of the technical toolkit. When we look at the toolkit today, we'll talk about how the S&P, the NASDAQ, sort of essentially range-bound, right? I was talking with Tom Boley, one of our StockCharts contributors earlier this week, about essentially from May of last year to January of this year, we're at the same level that we were for the S&P, sort of in that 38 to 3,900 range. We'll look at a lot of charts here in a little bit. Did want to let you know about the upcoming guests. Excited to talk to Mish Schneider. She's one of the best and always brings some good charts along with her. Tomorrow, we have Jeff Hirsch. Jeff's the editor of the Stock Traders Almanac, an expert in seasonal trends, and we'll talk about what the calendar suggests in terms of price action through 2023. Tony Dwyer from Canaccord Genuity is going to be joining us on the show on Thursday, the 12th. Then on Friday, the 13th at 10:30 a.m. Eastern, we will be airing our Stock Charts Market Outlook called Charting Forward 2023. Mish Schneider, today's guest, graciously accepted my invitation to be a part of that roundtable discussion. We'll be joined by Greg Schnell of Osprey Strategic, Tom Boley of Earnings Beats, and we'll have a really good conversation about what we are seeing, what we are thinking, and what to expect. What charts are most important to us as we think forward through this year? So make sure you tune into that for sure. Let's continue on our show today with our market recap. I do want to start with a poll that we ran recently on our live stream page. We always have a poll at StockCharts.com. Looking at the TV screen, also on our social media accounts. So make sure you subscribe to our YouTube channel. Give us a follow on Twitter at FinalBarSCTV and at StockCharts. Here's what we asked you recently. Know your technical indicators. Which of these would be considered a trailing stop indicator? Parabolic systems, RSI, DMI, and ADX. Now, if you know your technical analysis and your technical indicator history, you'll know that all four of these were designed by the same person, Wells Wilder, who wrote a seminal work in the 1970s. Boy, it's called New Concepts in Technical Trading Systems, I think, and basically unveiled things like RSI and ADX and parabolic studies, things that many of us take for granted. He created all those as he was analyzing the commodity markets in the 60s and 70s. And the correct answer, as 40% of you said, is parabolic systems. Parabolic systems is in that group of things like, arguably moving averages, maybe things like the chandelier technique, which Alexander Elder popularized in some of his books, and others. Things like RSI, really more measure of momentum, DMI, a measure of directional trend, and ADX, a measure of trend strength. Parabolic systems is one of those trailing stop indicators. Why are those important? Because one of the worst mistakes you can make as an investor is hold a losing position too long. I was taught that all large losses begin as small losses. So hopefully one of your New Year's resolutions in 2023, keep your losses small. I hope we don't have to trigger a lot of stop losses here in the near future, but you never know when you will need them. So parabolic systems, certainly one of those techniques. Continuing on with our market recap today, you can see the S&P 500 just below 3920. Nice move higher through the course of the afternoon, and that's up 0.7% from yesterday's close. You can also see the NASDAQ composite up 1%, NASDAQ 100 a little bit below that as well. The VIX coming off, and actually the VIX coming down today. So you have stocks going higher, the VIX coming down, so volatility lessening. One of those things we talked about looking for was, could you get a sustained rally on low volatility? Then all of a sudden, this market would look very different than what we saw in 2022. 2022 was marked with, markets essentially moving lower for the course of the year, and with volatility remaining fairly elevated, certainly compared to a more of a sort of low volatility uptrend like you saw in much of 2021, right? 2022, a very different look. Be interesting to see if you could get a move above some of those key levels like 4,000, 4,100 on the S&P. The volatility remaining low, you will hear my tone become much more constructive if we would get those sort of things. But first things first, VIX gets below 20. I think that we could call that more of a low volatility environment. Not there yet. Interest rates moving higher today, and it's an interesting juxtaposition here, because you can see that rates moving higher, right? 10-year yields up to 362, long bond yields around 376. At the same time, some of the growth-oriented sectors like communication services and consumer discretionary actually at the top of the list. It's a little bit counterintuitive. If you think about the traditional relationship, higher rates tend to be less hospitable to growth stocks, essentially because the prospects of their future earnings growth, right? If you take those back to what you're paying today for future earnings, higher rates basically make that future earnings potential a little less attractive. But that trend, while absolutely true in sort of the medium long-term time frame, doesn't mean on individual days you can't have some weird combinations, right? So today you actually have bonds moving lower. You have growth stocks, and for the most part, actually outperforming today. Bond prices, of course, coming down, and the dollar index, not too much of a change from where we were yesterday. Sort of mixed bags overall for commodities, and not a lot of winners or losers around the horn here. But gold up about 1/3% using the GLD. That gold trade is one that certainly is a potential area of strength going forward. We've talked about the strength in some of those gold miners through the course of the recent weeks. Finally, cryptocurrency is actually starting to spike to the upside. Bitcoin actually having a pretty decent day, moving above 17,400. 18,000 is a sort of a line in the sand that I've been drawing on the chart of Bitcoin. As long as we remain below there, how excited do you want to get about a chart? And I've often found that simplifying into lines in the sand, right? What's a level, an alert that you can set on StockCharts or whatever platform you're using as a reminder of when Bitcoin hits 18,000, I want to review the chart again, can be really, really helpful. By the way, if you're looking how to do that on StockCharts, in the upper right corner of your dashboard, there's a little button that says alerts. You can set alerts on any of the price data that we have on our platform. Let's look at a daily chart of the S&P, just see what happened today. So we've been talking about this 3,900 level because it's a number of different levels, or a number of different reasons why 3,900 could be of interest. If you take the August high to the October low, that's from last summer and fall, you can see that 50% of the way up is around 3,900. We actually first reached that level from below in late October. That was that big pullback in early November before we broke above that. Then look how 3,900 became support a couple times in November and December. Now we're back below, and once again, we're bouncing up to that level. Right now, this week, that's actually lining up really well with the 50-day moving average. So we're closing back above the 50-day moving average for the first time since mid-December. That's encouraging, right? That's kind of what you'd want. Bullish charts tend to get above moving average resistance and not stall out there. So that's encouraging. When I'm looking at this chart, though, I can't help but notice the big area right above where we're at, which is the 200-day moving average at 39.90. The trend line connecting the 2022 highs, which is currently around 40.30, we'll call it, and also the highs from November and December around 4,100. So we are just below a cluster of resistance levels, which means two things, generally speaking, in my mind, when face this with this sort of chart in general. Number one, expect resistance, right? So if we rally up to those levels, it would be pretty surprising to not have at least some sort of pullback, some recognition of that, the importance of that level of resistance. On the other side of it, though, if you would break out of that level and follow through to the upside, a break above 4,100, all of a sudden this market looks very different, because that would mean a nice higher low in late December, a nice higher high if we would break above 4,100. Until then, though, again, I'm not sure how exactly excited I would want to be about about stocks just yet. Having said that, certain breadth indicators are actually showing plenty of positive support. Here's the S&P, and below there we have the percent of S&P stocks above their 200-day moving average, currently at 61%. Percent of stocks above their 50-day moving average, currently around 68%. I have these pink horizontal lines right at the 50% level. Generally speaking, these indicators are above 50%. More than half the stocks in that group are in uptrends, right? As defined by where they're at relative to those moving averages. Even with the choppiness, even with the pullback in late December, they have both essentially remained above that 50% level. Let's take a quick commercial break. We'll be back with today's guest, Mish Schneider. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close for our show. We have a lot of really cool plans for the show through the course of 2023, including our brand new studio, where we'll be hopefully very, very soon. A lot of great ways to enhance the viewer experience for you. We're excited to unveil those out to you through the course of this year. A couple quick announcements before we bring on Mish Schneider today. First off, we welcome your questions. We'll do a mailbag segment later in today's show. We'd love to feature one of your questions live on the air on Friday's show. Best way to get your questions to us is via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions, hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com, our Market Outlook special coming out this Friday. Larry Williams put out his Market Outlook last week. A lot of our StockCharts contributors have done some fantastic programming in the last couple of weeks to help you make sense of last year and really set the stage for positive returns in 2023. All of that content is available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Mish Schneider. Mish has been a frequent guest on the Final Bar. She is the Director of Trading Education at MarketGauge, coming to us from Santa Fe, New Mexico. Mish, great to see you. Happy New Year.
Happy New Year to you.
So we're in this sort of interesting, choppy, kind of sideways, uncertain period. You're showing us your chart of the KRE, the Regional Banking ETF. Can you talk us through what you're seeing in the space and just how you're making sense of the markets here?
Well, I chose to bring this chart to Final Bar today because it's a sector that people don't really think about very much. It's part of the economic modern family. It's my prodigal son, because as we know, banks have had a history of getting you all in and then totally blowing your money. And then, of course, coming back asking for forgiveness and getting bailouts. And as we're going into bank earnings, I thought this was a particularly interesting sector to look at, not just from a technical standpoint, but it also really takes a pulse of more rural America. What are they doing in terms of their savings and borrowing? And right now, you can see this has been floundering as we're looking at this chart right here. Above the 200-week moving average, it got real close to breaking it a few weeks ago and has held. And so what it's telling us right now is, yes, we're bouncing off some support. If you go back to look just a few months before, is it possible that we're establishing triple, quadruple bottoms? Absolutely. And that's the conundrum of the market right here. Are we simply holding support for something much worse to come? Or are we holding support because we're going to get this monster rally in spite of all of the logical reasons why we shouldn't? And so you have to look here, especially this week. If we can get through 60 on the daily chart, I think that would be very constructive. If we break down under 57, not so much. You can see on the leadership bar underneath that, as long as the blue is over the red, it means it's slightly outperforming the S&P 500. And the real motion indicator below that, which is the momentum, shows that the 50 is over the 200. That's bullish. But if you look at the actual dotted line, it's hitting right into resistance. So when you talk about this sideways action and how we have these key levels to clear, this is another representative, although not nearly as strong as the others, which means it could be a ball and chain or it could play catch up.
You know, I want to get to your charts of your second set of charts here, but just quickly, if we could, we have a lot of bank earnings coming out. Earnings season obviously getting started here this week, but Friday, you have things like Citigroup, Bank of America, JPM, all reporting earnings. As a technically oriented strategist and trader, how do you think about a chart like this going into earnings? Is there some way that you would look at it differently, or do you just focus on the price action as a way of navigating what could be an uncertain period here?
Well, I certainly will look at the price action, but I also look at the different time frames, because the daily charts are showing this enthusiasm that we're seeing in the overall market. And the weekly chart, as you're showing now, is not necessarily as enthusiastic, but definitely not pessimistic. So to me, the bank earnings will be interesting, but I'll be much more interested in what they say in terms of forward guidance versus what they report in terms of last quarter. And I think that's pretty much what everybody's going to be looking at. And you have a bank like JP Morgan, which that chart looks totally different. It's in a clear bullish phase and doing very, very well.
Yeah, nice run off of the lows for JPM. Next chart is your daily chart of HYG. That's a high yield ETF. Can you talk us through this one?
Well, I love looking at junk bonds because it really is such a great indication of risk on, risk off appetite. And it has been a guide for us since before COVID. So here we are now in this year when things started to look so negative, even at the end of December. This chart really held up. And not only has held up, you're looking at the daily chart right here. Mm-hmm. You can see that with today's action, we almost have two shooting stars, if you're a candlesticks fan, right at a critical resistance level of the 200-day moving average. That gets pretty exciting, really, because it's going to tell you very quickly. Either this will roll over and all this enthusiasm will begin to wane, or if we can pop through this, it means that these bond traders are still looking at this high yield and not terribly worried about any kind of crash. And so that's why I think junk bonds are so key to what happens here in the picture right now.
Yeah, you mentioned the 200-day moving average. Mid-December, the HYG got right up to the 200-day and had a pretty decent drawdown from those levels. Your weekly chart of the HYG, does that shed any light in sort of the overall picture with a high yield debt?
Well, it's exactly almost a mirror of what we just said about regional banks. And on the daily, you look and you go, oh my God, this market looks like it's just going to explode to the upside. You step back more into more of an intermediate term, and it just looks like we're seeing a nice bounce in a bear market. And clearly that's what you're seeing here with a negative slope in the 50-week moving average, the 200-week moving average above that. You see momentum there, really not necessarily as pretty because the 50 is under the 200, which means it's still in a negative phase. And in terms of the leadership, it's on par with the SPY, but not really taking any key leadership here. So that's why I think this is still a trading range market. And these two charts essentially are telling you, have fun, have your risk parameters in. Obviously, I listened to your conversation about stop loss is so important. But also be really, really prepared that for the big surprise to the upside, or that things aren't as good as they seem right now, and we're just a few days away from some sort of rollover.
Mish, it's awesome to get your take as always. Super excited to have you involved with our market outlook coming up later this week. Give our best to the team at MarketGauge, Keith and Jeff and everyone, and we'll talk to you again soon.
Thank you so much, Dave.
That's Mish Schneider. Mish is the Director of Trading Education at MarketGauge, coming to us from Santa Fe, New Mexico. I love those charts, and a lot of little nuggets to unpack there. But I think what was really interesting, you caught a couple times, just the fact that I ask all my guests to give me, a set of charts, whatever they'd want to talk about, and we sort of start there. Mish intentionally picked two different timeframes on each of the two sets of charts she gave us, and reinforced in her comments there the importance of looking at the different timeframes and thinking about the weekly trend, the longer term picture, thinking about the daily trend and the shorter term fluctuations. Multiple timeframes really help to illuminate. If you find that you're struggling to figure out what is going on with a particular chart, always dial it up or down a time frame and see if you can get a little more granularity, a little more color by looking at the big picture. So great take there, as always, from Mish Schneider from MarketGauge. Let's continue on our show today with our next segment, the mailbag. As a reminder, the mailbag's always open. You can email us at thefinalbar@stockcharts.com. And let's get to question number one. Dave, on your regular chart, the S&P 500 chart, you use a bar chart. Why is that? And you sent this after we did a show, I forget if this was right before the holidays or even last week, where we talked about closing prices and the importance of being patient and waiting for the close as sort of a, instead of overreacting to when something is busted or broken, a level is broken intraday. So if closing bar charts are so important, why look at the bar charts, right? Why not look at just the closing prices? So here's what I learned, right? And I will tell you, I've had discussions with a lot of people about bars versus candle charts. And I will tell you, at times in my career, I've spent a lot more time using candle charts. And even with any of the charts we talk about, I often bring up this chart here, which is a chart style that just focuses on the candle patterns. If I was a shorter term investor, maybe like a a swing trader, a position trader, I would probably use candlestick analysis because candlesticks are really optimized for that sort of 1 to 3 day time frame. If you're looking at the daily candle chart, right? On shorter term time frames, you can do hourly candles or 5-minute candles or whatever you want. But looking at daily candles, which I think are really valuable, it's helpful, but it's really a short-term thing. It's telling you about the next couple of days. So it's interesting to me when I see a candle pattern pop up, but it's not a core part of my process. For me, my main goal is to think about the trends in the price relative to some key levels like Fibonacci levels, support and resistance levels, moving averages, looking at momentum and looking at relative performance. And that's why my default chart looks kind of like this. So as I was bringing up FRC, because I think they're reporting on Friday, reporting earnings, this is sort of my basic starting point of thinking about what this chart was telling me. Having said that, why do I not look at closing prices? Because there is information embedded in bar charts that are not there on closing prices. Closing prices, the benefit is it gets rid of the noise, right? So if I take this chart and switch from open, high, low, close bars to solid line, if I'm just thinking about the trend, this is what I would do. And so on some of the charts in my Mindful Investor Live chart list, you'll find that it's just these series, just looking at closing data, because I'm trying to think less about intraday movements and more about the trend. And so the closing prices are the best way of understanding that. But as a starting point to thinking about a stock, particularly being an equity-oriented investor, gaps end up being pretty important to me. Where we closed relative to the range. Do we have days that are closing near the higher end of the range or the lower end of the range? Do we have a big gap off of the lows like you saw with FRC after it made a new 52-week low in early November? That information is not available on a closing chart. So bars or candles give you a sense of the trading range. They give you a sense of gaps. And those are two important pieces of information that I generally like to know about. Having said that, these charts that I show you, I show pretty much this chart only on the show because it's for time and for brevity. But in the normal course of my analysis, I'll often bring up different timeframes. I'll bring up the candle chart and other things to try to make sense of that particular stock at that particular moment. Really good question, though. Question number 2, Dave, we know the Fed ultimately drives interest rates, but the Fed doesn't change minute to minute. So my question is, what drives the minute by minute changes in interest rates or the price of bonds? So it's funny, I was talking to a friend of mine earlier today. We were talking about where financial advisors and a lot of individual investors, what areas of financial sort of market analysis are they underweight? And the general things we talked about were number one, risk versus reward and focusing on risk. When you work with institutional investors, there's a laser focus on risk because they have to manage risk versus return. That's why I think it's Sharpe ratios and other things that try to capture that. It's thinking about stop losses and making sure you manage the downside and making sure you cut your losses when appropriate and making sure that you think about your exit strategy as much as your enter strategy. And the third part was intermarket analysis, particularly the fixed income markets. When I worked with professional money managers, we talked a lot about the fixed income markets, a lot about what fixed income investors, what bond investors were pricing in, what we could learn by looking at bond prices and looking at interest rates, and how that related to the equity charts that we were looking at. So what I would tell you is what you have to remember, and maybe a better place to bring this up is with the dynamic yield curve, which is a really cool visualization we have on StockCharts. This shows you the shape of the yield curve from the short end to the long end, and then the price of the S&P 500. You can actually click on a historical date. You can move your mouse or click animate, and you can watch how prices evolve and watch how this yield curve changes day to day or week to week or whatever you're looking at. So what's interesting about this is when you think about it, the Fed doesn't control this whole thing. The Fed is actually involved on the far left side and even to the left of this side. They're dealing with rates that relates to how banks borrow from the government, how banks lend and borrow to each other. And so that is a really short-term set of rates called the Fed funds target rate, the discount rate, et cetera. The rest of this yield curve is driven by investors and driven by auctions and driven by a lot of bond investors, a lot of money managers making big bets on different parts of the curve and betting and taking action based on duration and also thinking about risk and how confident they are in the U.S. economy versus other global economies on the strength or weakness of the dollar, et cetera, et cetera. So when you're looking at something like the TLT or the AG, you're really capturing more of bond investors and whether they are taking on risk or lighting up, whether they're going to the safety of U.S. Treasury debt or somewhere else. The Fed is really the shorter end. And what happens when you think about it that way is this is how this can sort of happen, which is the inverted yield curve, which is the Fed raising rates up to this point. But the way that investors are treating the longer end of the curve is actually below, which is unusual. This is an inverted yield curve, meaning short-term rates are higher than long-term rates. Look back in history at when that has happened. And as a quick cheat sheet on that, it's basically every major recession is at an inverted yield curve right beforehand. And that's why that's a key level we look at. So what the Fed is doing versus what the bond investors are doing, which is a lot of capital moving around different parts of the yield curve. Thanks so much for that question. Next question. You said the bullish percent index dipping below 80 was a sell signal. Is there a similar buy signal? That's a really good question as well. Give me 1 second here. Let's look at this chart. Actually, I want to look at the Mindful Investor Live chart list. We will look at this chart here, which is looking at the bullish percent index. And what we want to look at are these signals here. I've highlighted in purple when we get above 70%, meaning over 70% of the S&P charts are bullish, right? Using their point and figure charts of all 500 members of the S&P. Below 30% means less than 30% of the S&P 500 point and figure charts are bullish, or basically over 70% are bearish. You can see when the indicator's above 70% then comes back below, which is the end of the shaded area. That is usually, certainly in the last 13 months, coincided with a pretty significant top in stocks. When this indicator has gone below 30% and gone back above there, they've been fairly tradable bottoms, and that's the indicator I would look for. So what's interesting right now is we never got back below 30%, actually. After getting the sell signal in early December, we never got that negative because we never got that bearish. As the S&P held 3,800, not a lot of the point figure charts actually got to that negative area. So at this point, no real buy signal yet from this indicator in terms of my interpretation. I'd be looking, if we do get a further rally, do we get above 70%? That would initiate the warning signs or the red flag looking for a potential sell signal. So below 30% and back above would be my version of a buy signal using that chart. Great questions, you guys, as always. Keep them coming, but we have to wrap the show and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We'll look at communication services. Communication services, I believe, the top sector today, if not one of the top couple sectors. And when you look at the XLC, you can see the June low from last year coincides pretty well. That's that green shaded area with the October high, the November high, the early December high, and not too far above where we're at right now. This is what we call a pivot point, or maybe it's a concept called polarity, where a level of support becomes a level of resistance or vice versa. What that means is that sort of $52 level is a pretty key level for the XLC. We rally up to that level. That looks a lot like these previous peaks. We break through that level. We follow through to the upside. That would clear the way to further upside. The 200-day moving average, not too far above. The 38.2% retracement level of this downtrend would be up around $60 a share. That's the highs from mid-August. Chart number 2 is looking at the percent of stocks above their 50 and 200-day moving averages. When you think about breadth, I like thinking about breadth indicators and some specific, very basic levels. I love to do more deeper analysis on these charts, but I like to keep it simple. Does this indicator remain above 50% if we would pull back at all, right? And that's why, the question of what happens if we pull back, what happens if this happens, et cetera, you don't have to worry that much about it, in my opinion. Take a breadth indicator like this, put a signal or put a big line around 50%. Keep watching this chart. If we would break down, we hold 50%. This is still a constructive pattern using these breadth indicators. We break below 50%. That would be a problem. So on a pullback, this is a key chart I would be watching if we get some weakness going into earnings season, which is what is really starting at the end of this week. Finally, yesterday, I highlighted Amazon, a mega cap stock, of course, making new swing lows October, November into December, but the momentum sloping higher. It's what we call a bullish momentum divergence. I was looking at industrial stocks earlier today, and Generac struck me as being a very similar chart. Lower lows, October, November, December, higher lows in momentum, oversold in November, not oversold most recently. Another chart showing a potential bullish rotation. Keep an eye on Generac. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. All of our previous interviews can be found at StockChartsTV.com. Special thanks to Mish Schneider from MarketGauge. For StockCharts, I'm Dave Keller. Be well, be safe. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.